Investing is one of the best ways to build wealth over time, but it can also be risky if you don't know what you're doing. Whether you're a beginner or even an experienced investor, mistakes are easy to make. Today, I'll take you through the top 5 common investing mistakes to avoid, helping you protect your hard-earned money and make smarter investment choices. 1. Lack of a clear investment plan. The first mistake many investors make is jumping into the market without a clear plan. It's tempting to invest based on trends, hot tips, or FOMO, fear of missing out, but without a strategy, you're setting yourself up for failure. An investment plan is crucial because it helps you clarify your goals, risk tolerance, and time horizon. Are you investing for retirement? For a major purchase in the next 5 years? Your plan should guide you in selecting the right assets based on these factors. Not every investment suits every goal. For instance, if you're saving for a house in the next 2 years, putting your money in volatile stocks might not be the best move. Long-term goals, like retirement, can handle more risk, while short-term goals should focus on stability. So always start with a plan that aligns your investments with your specific objectives. Timing the market, trying to buy at the lowest price and sell at the highest, is one of the most common investing traps. Unfortunately, even experienced investors struggle to consistently predict market movements. The stock market is unpredictable, and trying to time it often leads to buying high and selling low, exactly the opposite of what you want to do. Instead of timing the market, focus on time in the market. The longer you stay invested, the more potential your money has to grow, thanks to the power of compound interest. Regularly investing in the market, regardless of the ups and downs, allows you to take advantage of dollar-cost averaging, which can reduce the impact of volatility on your investments. In short, consistency is key. 3. Not diversifying your portfolio. Another common mistake is putting all your eggs in one basket. Many investors fall into the trap of investing heavily in a single stock, sector, or asset class they feel confident about. While that one stock or sector might be performing well now, relying too much on one area can lead to massive losses if things turn south. Diversifying your portfolio, spreading your investments across different asset classes like stocks, bonds, real estate, and commodities can help reduce risk. If one investment underperforms, others might perform better, balancing your overall portfolio. 4. Ignoring fees and costs. Many investors overlook how fees and costs can erode their returns over time. Whether it's management fees for mutual funds, commissions for trades, or hidden costs in your investment accounts, these expenses can add up significantly over the years. Just a 1% fee might not sound like much, but over time it can take a substantial chunk out of your portfolio's growth, especially with compounding in play. 5. Letting emotions drive decisions. Investing is as much psychological as it is financial, and one of the biggest mistakes investors make is letting their emotions drive their decisions. Fear and greed are the 2 dominant emotions that can lead you astray. During market crashes, fear can push you to sell off your investments, locking in losses that could have been recovered over time. On the other hand, when markets are surging, greed can lead you to chase after high returns by buying assets at inflated prices. Avoid 5 common investing mistakes to protect your investments and enhance success. Subscribe for more tips to improve your financial future. Let's grow together, and see you in the next video.